And good morning once again, options traders. Well, this presentation comes to us as a question from another trader who was asking for a review about how to roll straddles by either buying or selling vertical spreads. I've talked about this a number of times in previous videos, but the big question that he had for rolling straddles, and this is the one that I get from many people, and they'll say, well, I understand on the way up when you're selling these spreads for credits that these credits are landing in your pocket, and that's what's shifting this risk curve higher. But what I don't understand is when the stock price falls and I'm trying to roll this straddle down, I have to buy those vertical spreads. And because of that, they think they need to sell the put spreads, which you certainly could, but it's easier just to keep it on one side of the board, either all calls or all puts. And to really see why, you have to understand your synthetics and some pricing principles. But I think it's a very good topic because it's one that so many traders just find very puzzling, and it's actually quite easy if you understand a few basic option principles. So let's go see if we can answer this question. Why is it that if the stock price falls with your straddles and you have to buy vertical spreads, why does that shift the risk curve higher? So let's revisit a previous presentation, and I talked about how unstable vertical spreads can be. So for instance, let's say that you buy a $100 straddle for 10. So remember, this means you're going to buy the $100 call, $100 put with the same expiration. And if you do, you get this V-looking risk graph. And we have these positive deltas over here from our long call, and we get these negative deltas over here from the long put. And so that's what's causing this risk graph to have this V shape. Now, on one hand, yes, it's true you can make money whether the stock price rises or falls. Almost. You can make money if the stock price rises or falls far enough. There's a very big gamma component to a long straddle, and we can see that by this wide break even right here. So let's say if we paid 10 bucks for this 100 straddle, the lower break even at expiration is 90. That's just the 100 strike minus 10. And the upper break even is the 100 strike plus 10, or 110. Well, that's a pretty big range. That's a 10% rise or fall just to break even. So if you hear people touting the straddle because it makes money no matter what the stock does, that's definitely not true. It is true it makes money if it rises or falls, but it's got to be fast and aggressive. So because of that, this is the frustration that a lot of traders run into. They buy this 100 straddle, stock price comes up maybe after a few days, and they're going, well, I'm almost getting profitable, comes up to here, maybe it's starting to show a little bit of profit, and then what happens? Comes back in the other direction. And then it falls, sits sideways, falls some more. In the meantime, it's decaying away. Don't forget that. You've bought a call and a put. And then it falls some more, and now you're getting excited saying, oh, well, maybe the put's going to go in the money. And then suddenly it falls some more, and finally it looks like that put is in the money. We're starting to show a very small profit. And then what happens? Goes back in the other direction. Stock price rises. And so it's this action that really tends to frustrate traders with straddles. And so one of the things you can do to continually center your straddle, so let's say if the stock is at 105, we'd like to move this V, this pointed part here, over at 105. And that way we can begin making money immediately, or at least be on the negative delta side of that curve if the stock price falls, or on the positive side if it rises, so that you don't get stuck in this whipsaw action. So let's use this as our example. Let's look at a number of ways why we can shift this risk curve up as the stock price rises. And then we're going to kind of solve this mystery, that big question, why we can do the same thing if it falls. But let's start with the upside. So maybe the stock is here and it's now worked its way up to 105. Why is it that if I sell two vertical spreads, two of the 100, 105 verticals, I can shift this graph up and over here to the right? Well, there's a number of ways to see it. Here is our long straddle. We're long one of the $100 calls. We're long one of the $100 puts. If I sell two vertical spreads, two vertical call spreads, And yes, I could do it with puts just as easily. But for this video, I'm just going to stick with the calls. I'm going to sell 2 of the 100 strike and buy 2 of the 105. That is selling 2 100, 105 vertical spreads. But notice what happens when I put this trade on. These get a cancellation here. I'm long 1 and short 2, so on a net basis, I'm actually short 1 of the 100 calls, and I'm long 2 of the 105s. So what have we got right here? I said this is where you would need a little bit of option pricing theory. This is a synthetic short. So we are long the put, short the call. It's going to behave like short shares of stock. So think about it. If you are short shares of stock and you own 2 105 calls, what does that give you? Well, it's going to give you a straddle, but at 105. So here's the first way that I like to teach traders to visualize it. Remember, we've got 100 deltas over here on the right. When you sell that first call, remember you've sold 2. You sold 2 calls and bought 2 calls. So when you sold that first $100 call, you have simply closed it out. So you're going to take this line and just flatten it. So imagine just picking it up and turning it sideways. That would give you a synthetic put. If you sell the second call, we now create negative deltas. If you're short a call, you have negative deltas. And now we can see there's our synthetic short. But then we buy 1 call at the 105 strike, and if I do that, what happens to this blue line right here? We create a bend right there at 105. If I buy a second call, what happens? I now create 100 deltas, and then I get the V centered right there at 105. But notice that we did not reduce the straddle by 10. I used to have a maximum loss of 10, and now it looks like it's down here at minus 15 because I've got what? 2 liabilities, right? When we sell a spread, it's a liability equal to the difference in strikes. But because I've sold it twice, I don't really create a $10 liability. It's a $5 liability. The sale of the first one just closes this first call, and then we go into the synthetic short, and then we come back up into the straddle. So now, how do we shift this higher? All I've done so far is I've created a $5 liability. Well, remember, when we sell it, we're going to get a credit. And if the total credit is bigger than this $5 liability, then we will shift it higher. So this is one way I think is very probably most telling of why it works. And I would certainly encourage you to work through this until it makes sense. But here's another way that is probably a little bit easier. When you sell your vertical spread, this is the risk graph. We're selling 2 call spreads, it's bearish. But notice what's happening out here in the wings, in the far left and the far right. I have 0 deltas out here. If I add 0 to something, what happens? Nothing. There's no changes. In other words, I have the same straddle. Look over here to the right. For all stock prices above 105, what happens? Absolutely nothing. I have 0 deltas out here. However, because I've sold 2 straddles, in between the strikes, I am short 200 deltas. But if you remember, my long straddle was initially long 100 deltas, so on a net basis, I'm actually short 100. And that's why we don't create a $10 gap there, it's only $5. All right, so this is the original straddle. There is my 100 deltas initially. When I sell 2 straddles on a net basis, I'm short 100 deltas, and so I only come from minus 10 to minus 15. All right, so those are a couple of ways to visualize it. And yes, I know it can be tricky, but trust me, if you understand your options, you can see strategies like this and say, this would be a great hedge, and here's how it's going to work, and I know it's going to work because I understand these principles. So now, how do we shift this higher? Well, as I mentioned before, it's by selling 2 verticals. You're going to generate a credit from the sale. So if we sell 2 100, 105 verticals, yes, it creates a $5 liability for the reasons we just saw. But remember, Vertical bull spreads get more valuable as the stock rises. The value of that long spread is getting more and more expensive, which means for us as the seller, we're getting a bigger and bigger credit. So let's say I can get a $3 credit times 2, that's a total of $6 in my pocket. When I balance that against the $5 liability, I have a net $1 gain. That's why the risk graph shifts from down here up this way. Now, in this example, I made it $5 just so you could see the difference. We would actually just shift up by $1. But that's why it shifts, because the total credit is bigger in this example than the $5 liability. Okay, so that's kind of the review, and that's what most people say. All right, I kind of get that. It's because we're getting this credit. Well, again, that's mixing debits and credits. Get out of debits and credits. You are also creating a $5 liability. And it's the opposite that happens when it falls. And again, this is where traders, including the one that I spoke to, said, I just don't get it. If the stock price falls, I have to buy the vertical spreads. And that means I'm putting money out of my pocket, and therefore this risk graph should sink lower. Why am I saying that it's going to rise? All right, good question. What if the stock falls? Well, as the stock price falls, the vertical call spread's value falls. So if we buy 2 of the, let's say the 95-100 vertical spreads times $2 each, we're going to spend 4. And again, traders are saying, if I'm spending money, I'm sinking that risk graph. And again, traders think it's this debit that causes the reduction in gains. But what they're forgetting is another pricing principle. Lower strike calls box in gains. That's the trick right there. That's the answer to the big question that everybody has with using vertical spreads to hedge straddles. How can I spend debits and shift that risk curve up? It's because you're boxing in gains. And again, it's a big confusion where people get hung up on debits and credits. Always remember, debits are credits, credits are debits. Anything you can do with a debit, I can do with a credit. Anything you can do with a credit, I can do with a debit. So it's a complete misperception if you say that the risk graph must sink because I have spent debits. You're forgetting that the lower strike calls will box in some gains. So let's go back to our 100 straddle for $10. Here's the risk graph. And as we saw when we were selling verticals, we went this way. Maybe I do it again, sell the 105, 110 vertical. I can shift it up even higher. But what if it falls back to 105? Well, if I buy 2 of the, in this case, 105, 110 verticals, I'm going to do this. Yes, it's going to recenter back here at 105 as that stock falls, but notice that it is shifted higher. The black curve sits higher than the green. So the reason is that I've got a $5 box for which I've spent less, maybe $4. So just think about it from this picture. If you are long, let's say the 110 straddle, mathematically you have the 110 call and the 110 put. If you buy the 105 call, you've got the right to pay 105 and the right to sell for 110 with that put. That's $5, no matter where that stock price is. Below 105, above 110, or anywhere in between, you have boxed in $5. And yet maybe you've paid $4 for that. And that's what's causing it to rise. So again, I know it can be very tricky, but this is why I'm a big advocate of telling people you've got to understand your pricing principles and your options theory. Otherwise, you're going to be missing the very heart of options trading. This is what it's all about. Being able to hedge risk as things move. But if you talk to most traders, they buy a call or a vertical spread, it goes up a little bit and they close it. And that is absolutely missing the main point of options. So just to show that this works, let's put it to the test by going to an Excel spreadsheet. Okay, so now we're into an Excel spreadsheet that I put together. It's just an expiration risk graph that allows us to look at long, shorts, calls, and puts. So let's say we have one long call at 100, right there, and one long put at 100. There's our V. And of course, we have to spend money for it. Now, just to make it simple, instead of saying, let's say 5 and 5, I'm just going to make it $10 over here for the call, and we have 1,000 maximum loss. This is the example that we looked at. Now, let's say the stock price rises. We're going to sell 2 vertical spreads. So let's do that. If we sell 2 of the 100 call and we buy 2 of the 105, there's our synthetic short. Now look at what's happened. We've recentered at 105, but we've also sunk to a maximum loss of $1,500. See, it's a $5 liability. It's not a $10 liability, it's a $5 liability. But we receive a credit for it. So if I get a credit of, let's say, $3 times 2 spreads is $6. Netted out against this $5 liability here, watch what happens. Let's make it 3. And there we go. We are $100 off of this. You see, if I point right there, you can see that little box says minus 900. We've raised this by $100. That's just the difference between the liability and those credits. Now let's go the other direction. And actually, it might be easier. Let's clean it up to do this. Let's just do back to our starting point, minus 1,000. And let's say it drops to 95. Now we have to buy the vertical. So let's say that I have to buy the 95 100. So I'm going to be long 2 of the 95 calls and short 2 at the 100. And now we can see that we are centered at 95. Stock is down here at 95. I've recentered my straddle. But look at this. See, we used to be at minus 1,000. Now I'm at minus 500. What happened? We have boxed in $5 of value. I have the right to pay 95 with my long call, and I have the right to sell for 100 with my long put. There's your $5. Now, of course, we can't buy 2 of these spreads for free. So let's say that I have to pay maybe $2 for them, or 2 times 2 for a total of 4, but $2 each, which would be 4 netted out against this $5 box, should give us a net of $100. And there we go. We used to have a max loss at 1,000, and you can see that black line is shifted up a little bit, and if I point right there in that little box, it now shows it's minus 900. So that's really the trick. And again, the answer to this question that so many traders have is, why is it when I buy the vertical spreads that I can shift this risk graph up? And what they're overlooking is that they are boxing in value. And if you don't understand that, that's where a lot of traders say, well, I have to sell calls on the way up and sell puts on the way down. And you could certainly do that, but it's going to get a little bit messy after a while. It's just much easier to stay on one side of the board and let these things cancel out as the stock price rises and falls. So for anybody who trades straddles and has asked me questions about how you can hedge them by selling vertical spreads, it's one of my favorite strategies, also against long shares of stock. I've done videos on that as well. It's a phenomenal hedging tool if it's used the right ways. So I hope that at least gives you some answers for all of you who have dabbled with this strategy and wondered why we can shift that risk graph up even though we're spending money. So another lesson to take from this, if you understand your options theory and your risk graphs and your pricing principles, all of this stuff will be second nature to you. And that's when options trading is going to be less stressful and more profitable. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.